All right, Adam here with Interaxis, and I wanted to talk a little bit about financial advisors and RIAs, Registered Investment Advisors. We had the FA RIA Day, Financial Advisor RIA Day at Consensus last week, and it was a huge success. We had, I think, over 160 advisors in the room, but you often read things on social media, mainly from the crypto crowd, saying things like, if your financial advisor doesn't advise Bitcoin, then you should fire them. I often get questions, emails, messages from those in the crypto world. Hey, we want to talk to you. We want to figure out how to get more RIAs to sell our product or advise on our crypto product or something like that. And I want to explain to you all why financial advisors, why most RIAs, especially the large RIAs, are not jumping into crypto. And hopefully to explain it again. Usually I'm explaining crypto stuff to the financial advisors, but again, we're going a little bit backwards today. So why are RIAs or financial advisors not just absolutely jumping into crypto? Of course, you're going to say it's the best performing asset class, all those things, but that's actually a bit of nonsense. So we're going to talk about why RIAs are not jumping in first, a little bit of understanding about how most RIAs or most financial advisors work. And I'm going to say most. I know there are details here. I'm not going into too much of the nuance, hopefully, but I want you to understand a little bit about how it works. So first, we're going to talk about kind of traditional finance and traditional advisors. Let's assume that I am the RIA. I'm the financial advisor here. You are my client. And let's say that you come to me and we're managing, we'll just call it $1 million to make my math easy. And let's just say I charge a 1% AUM fee. AUM is assets under management, how most RIAs still charge their clients. I'm going to charge you 1%, and that 1% is annually. So in this case, it's $10,000 per year, and for most RIAs, that's paid quarterly. Meaning I'm going to kind of at the beginning of every quarter look at what your assets are, take 1% and then divide that by 4, obviously, because it's quarterly, and that's what is going to be taken out of your account and basically put into my account. That's kind of how it works. Now, some RIAs charge monthly. Obviously, the fees can be different. There's a lot of competition, but I'm doing this because it honestly makes my math easy. So let's assume you have $1 million and I'm charging you 1%. So currently, the way it works in most traditional assets is you come to me, we got $1 million, we start working together, I take your $1 million, and we actually use a third-party custodian. You don't write me a check. I am never the custodian of your money. I am never the one holding it. This goes back to old rules, but mainly we can look at, or we can thank Bernie Madoff for that, right? You don't write me the check. It actually goes to a custodian, someone else who holds it. That's for safety and security. So let's just say we're using Schwab. Now, there are other custodians. There's obviously Fidelity, Schwab are kind of the big two. There's others like Altruist and others that are up and coming and really great and really technology heavy what they do. But I'm going to use Schwab because most people know who Schwab is. So I apologize to all the other custodians out there. But let's just say it's at Schwab, and I put your $1 million in here. Now what happens is with that $1 million, I technically, again, cannot be the custodian. That means I technically cannot take the money out, but there's something called discretion. We have a discretionary account. We signed a discretionary agreement that says that I can trade these for you. I can make decisions to trade these. Of course, it's based on your investment policy statement and such, but I can trade them. But that discretionary agreement is basically a power of attorney, a limited power of attorney that says I can trade, but I cannot take the money out, meaning I can't direct that money to go anywhere outside of Schwab. You have to direct it to go somewhere outside of Schwab. I can't do it, and of course that speaks, so I can't send it to my own account. So I have discretion over this $1 million, and based on your investment policy statement, based on your risk profile and everything else we decide that you want, based on your goals, needs, everything else, we're going to allocate that to, possibly different portfolio managers, which are all on this platform. And those portfolio managers are likely going to put it into different, ETF portfolios, some into, equity portfolios, whatever it might be, again, based on your investment policy statement. Those portfolio managers are going to charge a little bit of a fee. Now, Schwab right now doesn't really charge a custodial fee. Now, why is that? How can they make money without charging a custodial fee? One, they make spreads on trades. They might charge trading fees. Plus, keep in mind, this is what we operate under in the US is called beneficial ownership. So Schwab basically has a ton of different shares of ETFs, of stocks and such, and then they kind of make an accounting entry that says that you are the kind of beneficial owner. Or you're kind of the owner, but you really don't own them. Schwab kind of owns them, and therefore, out of all these equities are trading, they make an accounting entry that says you as the client own certain ETFs based on what I have directed these portfolio managers to do. Schwab actually has all those. They can just make accounting entries, and they can lend those out. So they can make money lending out those shares or lending out cash if you have that in there. That's how they can make money, just like a bank does. Okay, so they can make money in so many other ways. So they're just trying to accumulate as much money as they can, because they get to make money on it in other ways. They don't even have to charge a custodial fee. Now, I'm going to charge my 1%. Portfolio managers might charge 25 basis points, which is 0.25%, something like 0.35% based on what they're doing. We might get an index funds, whatever it is. Okay, so you might be paying 1.25% all in annually. That would be $12,500 all in for your million, and hopefully we're making you more than 1.25% annually on your money. Now, within that, Schwab has all sorts of tools. They have all these, thousands of portfolio managers, thousands of ETF options, thousands of obviously stock options, bond options, all these other things you can do with your money within their custodial platform, so your money never has to leave. They also have reporting tools. They allow you to sign in. They send you a regular statement. And when I want to create reports for you so that we can have our biannual or semi-annual meeting, I can very easily create the reports, because everything is within the Schwab world. Everything is within this custodial world. So it makes it really easy for me as the financial advisor to do all this. Everything's within the same world. Plus, I can charge the fees really easily. I just tell Schwab what I'm charging, and every quarter they're going to automatically take out whatever I'm due. If there is no cash in the account, they will just sell whatever needs to be sold to derive the cash to pay me what I need to be paid based on the agreement that you and I have. This can all be done within the platform. Schwab, Fidelity, Altruist, they built these platforms to kind of make this easy and seamless. So I, as the advisor, can focus on helping you, the client, help you with your planning. I can go get more clients. I can do my social media. I can do all those other things, because Schwab is taking care of so much of it. Account opening. I can, if you're married, you and your spouse, I get your information, and I can probably open up 5 different types of accounts for you with a push of a button. That could be a joint account, separate accounts, IRA accounts, IRA rollover accounts, college savings accounts, all those things, because I have all your information. It makes it easy. It makes taxes easy, all of those things. Very easy for the advisor to make their 1%. Okay, and to do a really good job for you. Now, the question is, why hasn't crypto taken off? So let's kind of keep some of these numbers up here. Now, I'm not going to assume the ETF right now, the Bitcoin spot ETFs or the ETH ETFs that are coming or anything like that as investing in crypto. I'm going to call that investing like we usually do. But why aren't advisors jumping up and down to try to get crypto? Because it has performed so well, and clients are probably asking about it. Well, as you know, Schwab does not custody crypto assets. Altruist, to my knowledge, doesn't custody crypto assets. Fidelity actually does, and until recently you had to have $1 million worth of crypto at Fidelity for them to custody, and it still doesn't seem well. And if you know, in crypto, custody is different. Wallets and such are different than what we see as traditional custody within Schwab. So we have to look, if we're talking about, say, SMA or separately managed account platforms that can custody your crypto assets such that I can still have discretion over it, so that we can have a similar relationship, we have to look at SMA platforms, separately managed account platforms. And I'm not going to necessarily list them all, or I will list some of them, and I apologize. I'm going to use some of them as examples. That doesn't mean I endorse them or anything. But we have custodians over here, and some of those can be Anchorage. For instance, it could be BitGo, it could be Kraken over here as kind of centralized custodians. And then you have platforms built on top of that, because remember, Schwab has the custodian and the trading and platforms and account opening, everything on top of that. But we've had to build separate accounts. So you have Eaglebrook, you have Height Zero, you have OnRamp as different SMA platforms built on top of some of these custodians. They allow account opening, they allow discretion. Now, they don't necessarily allow the same types of accounts, all of the same types of accounts. Most of them will allow IRAs and such, but you can't necessarily have joint tenants and joint tenants with rights of survivalship and all of those. So that makes it a little bit harder. But you have these SMA platforms built on top of these custodians. Now, let's say you're that client with $1 million and we decide we're going to allocate 5% to crypto. And let's just say, for argument's sake, it's going to be a split. We're going to go 50-50 Bitcoin, ETH, and we're going to allocate 5%. Well, 5% of $1 million is $50,000. Now, what has to happen? I have to go set you up an account. We'll say it's at Eaglebrook on top of Anchorage as the custodian. And again, apologies to all my friends that are with all of these other companies. I'm not endorsing. I'm just saying this to make the point. Okay, I set you up an account with Eaglebrook on top of Anchorage. Now what has to happen is we have to get that $50,000. So you have $1 million at Schwab. We have to get $50K over to Anchorage based on your Eaglebrook account. Now, Schwab is not going to willingly give up that money. They have paperwork that has to be filled out. You have to sign things, because remember, I can't send the money. You have to be the one that affects that transaction. So we have to get Schwab to take $50,000 in cash. By the way, we can't buy Bitcoin over at Schwab. We have to get $50,000 in cash and send it over to Anchorage. Well, Schwab is not going to do this quickly or easily. You have to send paperwork. They're likely going to decline it at least once or twice, because you're sending it over to a crypto exchange. They're going to ask you questions. They might call you to verify, is this really what you wanted to do? And maybe after 30 days, you'll get $50,000 going over to Anchorage so we can set up your 50-50 Bitcoin ETH account. Now, remember, I'm still charging you probably 1%. On this. This isn't a new 1%. This is still the same 1%, so I'm not making any more money on this. I'm making 1% on the million. This $50,000 is part of the million. So now we have 950,000 at Schwab and 50,000 over at Eaglebrook. Again, $1 million. I'm making the same 1%. I'm not going to charge you any more for this necessarily. Okay, so now I have had to get you to sign all sorts of other disclosures as well for my compliance purposes, for my risk purposes. I've had to say, you understand that crypto could go to zero. You understand that this could be heavily regulated. You understand all these other things. You understand that these are not even necessarily, the SEC hasn't decided what a qualified custodian is, so you understand all of these things. I've had to get you to sign all that. That's a compliance nightmare for me. I'm pretty certain that I'm going to get audited by the SEC because if I'm managing client assets in crypto. So now, after maybe 30 days or more, I get this $50,000 over to Anchorage. We can set up your SMA account. Now, I still have to figure out how to charge you the 1% here, because if I'm charging you 1% on $1 million and it's all at Schwab, it's really easy. We just calculate what you have at the end of the quarter. We take out the 1% divided by 4, and bam, it goes into my account, which I have at Schwab. Now, we got to charge you 1% on the 950 plus the 1% on the 50 over at Anchorage through Eaglebrook. That is not that easy, because are we going to sell some of this to pay it? Or are we going to say, I'm going to charge you based on everything you have, but none of it's going to come out of your Anchorage account, but it's all going to come out of your Schwab account? Well, that's not a super easy calculation, because Schwab's they have $950,000, and I'm saying, no, they have $1 million. Believe me, I need you to pay me the 1% based on $1 million. So it doesn't make that very easy. On top of that, the reporting isn't as easy, because when you're all 100% at Schwab or at Altruist or at Fidelity or whomever, it makes it really easy for reporting, because everything is in the same place. We've seen all your transactions. Even if I use outside or third-party reporting software, I can see I can grab everything from Schwab, and when we have our semi-annual meeting, I'll go, here's everything we did. Here's how we grew. Here are the trades we made. Here's what we paid in fees. Everything else is real neat. If we have money at two different custodians, Schwab and Anchorage, or Schwab and BitGo, now it becomes harder, because I have to make sure that the data from these will feed into whatever reporting software I'm using and make the charts all nice, and it's just not feeding in that nicely right now. Of course, there are applications that are attempting to do this. There's APIs and all that, but it's just not that neat and seamless. So we have our semi-annual meeting. I have to spend a lot more time to create the reports. And remember, I'm still going through more compliance. And let's say in that time, Bitcoin went down, ETH went down, whatever. Now we have to have those discussions, even though it's only a small percentage of your allocation. And I'm doing all this to not make any more money, unless I am all of a sudden getting a whole bunch of new business that is crypto client, that is clients that have a lot of crypto wealth, in which case they're probably figuring out how to manage it themselves. I am not making any more money from this. So those at the top of the RIAs, the big RIAs, they're not falling over themselves to do this. They're not falling over themselves to add compliance, to add risk, to add complexity, to add more APIs to the reporting tools they use, to do all that, to add more research they have to do on crypto assets, to make no more money, probably even to make less money, because there's more fees that come out. Anchorage is going to, these are going to charge custodial fees. SMA managers might charge fees. So for the RIA to make less money, the same or less money, add compliance, add risk, add complexity, they're just not going to do it. They're not falling over themselves to do it, because we're not allocating that much, because it's a 1 to 5% allocation. And now that they have the quote easy button, the ETFs, the Bitcoin ETF and coming the ETH ETF, there's not a whole lot of incentive for RIAs to start moving clients into this. This is not even talking about self-custody. This isn't talking about going, directly on chain and managing client assets on chain. There's just not a lot of incentive, especially for large RIAs, to do this. Now, small independent RIAs, 1, 2, 3 person shops, are doing more of this. And I'm talking about going to crypto custodians, SMA managers, or even managing directly on chain, because that's how they're differentiating themselves. But the largest RIAs, the ones who have 100 and 200 and 300 and 500 advisors underneath them, they're not falling over themselves to do this, because even if clients are really asking for it, even if clients are asking for crypto exposure, the RIAs don't want to take on the extra risk and the extra complexity and the extra compliance for not making any more money. They're making plenty of money. The NASDAQ is at or near all-time highs. S&P is at or near all-time highs. Everything's just been going up and to the right for so many years. They have no incentive to jump into crypto. They have almost none to jump into crypto right now in this way. And again, they have the Bitcoin spot ETFs, they have the ETH spot ETFs coming up. That's most of the exposure people want. If people want exposure to other tokens, they're likely able to figure it out for themselves, or they're likely able to open up a Coinbase account. Maybe they can talk to their advisor about it, and hopefully their advisor has learned enough to be able to talk to them about other assets, where it fits in from a risk perspective, but just say, look, this can't be part of my AUM. I can't help you with other crypto tokens. I can't help you with what you have in Coinbase or what you might have in your own wallet. I'm not going to help you with that, because I'm not going to take the compliance and regulatory risk to do that. It's not worth it for the little amount of money I make at my 1% fee. So I'm telling you, we've gotten that question a lot. We've gotten it for a few years. How do I get this in front of more RIAs? How do I get my DeFi platform? How do I get my DeFi exchange? How do I get my crypto platform in front of more RIAs? And I've talked, and some others that we know have talked to some of the large RIAs, and this is why they're not falling over themselves to do it. They're starting to eke in with ETFs, but ETFs have actually slowed down the process of RIAs learning all about crypto, all about self-custody, transparency, everything that gives the blockchain the powers that we really like about it. They've slowed down their education on it, actually, because ETFs made it easy for them to give their clients exposure to the price of crypto assets without actually having to go down the rabbit holes, without actually having to understand custody and these aspects of it, because they're not making any more money if they move your assets into a crypto custodian, or they move your assets off of their platform into a different type of custody, into your own wallet. They don't make any more money, and that's why they're not falling over themselves to do it. That's not me saying they shouldn't learn. because obviously I want them to, but that's me saying this is why they are not moving that direction, because there isn't a financial incentive for them to do so. They have plenty of arrows in their quiver that are not crypto, that don't add risk, that don't add complexity, that don't add compliance needs. So I apologize for being a downer. Hopefully I will pep it up on the next one, but I wanted to explain, especially to my friends in crypto, why there hasn't been this explosion of RIAs wanting to add crypto to their platforms.